Hey y'all, Zach McDonald, your real estate agent here with Real Property Associates, and today I want to talk to you about something that could save you tens of thousands of dollars in taxes and even potentially more than that. And the topic for today is capital gains exemptions on the sale of your primary residence. So the big idea essentially is that if you are selling your primary residence, you may be eligible for an exemption on the increase in value of your home up to $250,000. And if you are married and filing together, that number could be $500,000 of gain. So I guess the big story here, the stories that I've come across, I've had a few different clients that have talked to me about selling. One, we had to wait a few months to list, and another, we actually waited an entire year to list. They had got the house from a family member at a good price, and then their family started growing and they needed a little bit more space, but they decided, and after talking with me, that it was better to wait another year to go ahead and sell the house. And we actually just closed on that sale here recently, but they are a great example of somebody who saved a significant amount in tax dollars by waiting just 1 year to sell their house. Now, a big monkey wrench could have been thrown into that if the proposed tax plan this year would have been passed, or at least the original version that did have a change in the requirements, and that would have put the ownership requirements to 5 out of the last 8 years. But what I want to do is I want to talk to you about the current requirements to get this exemption, or to at least put yourself in the running for it. So you have to meet two tests. You have to meet the ownership test and you have to meet the use test. Essentially, if you've lived in the house or owned the house, for that matter, for 2 out of the last 5 years, and also lived in the house for 2 out of the last 5 years, then you would, in theory, qualify for this exemption. Now, let's talk a little bit more about the requirements. The IRS outlines a few of them on their website. The first one is the ownership requirement, and they stipulate there that you have to have owned the house for at least 2 years. And if you've owned the house for at least 2 years, you would meet that requirement. Now, this only has to be one person in the couple. So if you are a married couple and you're filing jointly and one of the spouse members have owned the house for 2 out of the last 5 years, they would qualify under this. You wouldn't actually have to have both people, just one of the people. Now, the second requirement is the occupancy or residence requirement, and this requirement is that you've lived in the house as your primary residence for 2 out of the last 5 years. And they note that you don't have to have this doesn't have to be 2 consecutive years. It just needs to add up to 2 years out of the last 5 years. Now, in this instance, both spouses would need to meet the occupancy requirement. So both would have had to live in the house for 2 out of the last 5 years in order to qualify for the entire exemption on those gains. So if one person has and another hasn't, you're going to be somewhere in the middle there on those numbers. The third part, and this is something that we talk about ownership and we talk about use, and then there's another requirement. It's called the look-back requirement, and this requirement stipulates that you can't have used this exemption at any point during the last 2 years. So if you sold another home and claimed this exemption, you wouldn't be able to qualify if you were within that time of the last 2 years. So if you did every 2 years, essentially, you're potentially able to use this exemption. Now, there are a few things that would disqualify you, and there also are some exceptions to the rules and the timelines. But generally speaking, if you've owned your home for 2 out of the last 5 years, and it is or has been your primary residence at least 2 out of those last 5 years, you would be eligible to exclude $250,000 of gain in the value of your home, and potentially up to $500,000. So think about that. Saving taxes on $500,000 capital gains. That's a pretty significant amount. I hope this was valuable for you. If you have comments or feedback, I'd love to see those down below, and if you have other questions, please don't hesitate to reach out. I'm happy to be a resource for you.